Welcome to my Excel tutorial focused on the basics of accounting. I understand that the thought of diving into accounting can be daunting for many. It's a common fear, but rest assured, I'm here to guide you through this learning journey with simplicity and clarity. I'll remove your fears by starting with the very basics and gradually build up your skills at a comfortable pace. By breaking down accounting principles into easily digestible parts, and using Excel to bring those concepts to life, I promise that what might currently seem complex will soon become clear and manageable. Let's take this step by step and transform your apprehension into expertise. Together, we'll make accounting not only simple, but also empowering. Subscribe to this channel, then click on the link in the description below to get great free content. Even if accounting is not your profession, having a good understanding of accounting principles is often required or highly recommended in the fields of business, finance, management, business intelligence, computer programming, etc. If you use Excel, you are probably dealing with accounting data. It would be very beneficial for your career if you understood how accounting works. You would be better able to understand and perform data analysis. Accounting is basically the recording of business transactions. This recorded information is then categorized, summarized, and analyzed. There are different accounting methods for profit, not-for-profit, and non-profit businesses. We will be covering for-profit business entities. Accounting is basically the same for the three types of for-profit business: sole proprietor, partnership, and corporation. There are some differences. In Episode 1, we will be doing accounting for a sole proprietor. A sole proprietorship is a business owned and run by one person who is not incorporated. The owner is fully responsible for all financial aspects of the business, such as profits, losses, and debts, and the business is not legally separate from the owner. The all-important formula in accounting is the accounting equation. Accounting is based on this equation. This accounting equation has been in use since 1494. The assets of a company must always be in equal balance with liabilities and owner's equity. If the assets of a business are $1,000, then the liabilities plus the owner's equity must also total $1,000. What is on the left of the accounting equation must always equal what is on the right of the equation. Whenever you enter a transaction, you must always be sure that the two sides of the accounting equation are equal. If they are not equal, you have entered the transaction incorrectly. Assets are on the left side of the accounting equation. So what exactly is an asset anyway? An asset is anything owned by a business that has a current economic value or a future value. Examples of assets would be cash, buildings, any improvements that you have made to your buildings, cars, trucks, computers, office furniture, etc. You set up an account for each of these types of assets. Each of these accounts are listed in a chart of accounts, which we look at in the next episode. What is a liability? A liability is a current obligation you have to another party. It is something that you owe them. If you borrow $10,000 from the bank to pay for supplies, you owe the bank $10,000. That is your liability towards them. Examples of liabilities are accounts payable, income taxes, salaries you owe others, what you owe on your mortgage, etc. The people or businesses that you owe money to are called your creditors. Owner's equity is what would be left after all the business's assets were sold and its debts were paid off. It is often referred to as capital or net worth. In order to simplify accounting, I will use a very simplistic business that is easy to relate to and understand. The business is a lemonade stand. It is a sole proprietorship, so we don't need to worry about partners or stockholders. We will look at corporations in future episodes. What you learn in this episode will be the building blocks for future episodes. For this example, let's assume that 12-year-old Johnny wants to make money this summer. He decides, since he lives on a walking path with high traffic, that a lemonade stand would be a good way to earn money. Johnny's friend says he will sell him his lemonade stand for $40. Besides purchasing the lemonade stand, Johnny will need supplies to make the lemonade. Johnny goes through his coins to see how much money he has saved. It comes to $20. Cash is an asset. Since Johnny put $20 into his business, he has assets of $20. Johnny's business now has a net worth of $20. The accounting equation is in balance. There are $20 to the left of the equal sign and $20 to the right of the equal sign. Two extremely important terms to remember in accounting are debits and credits. What are debits and credits? Well, let's start off by removing conceptions by stating what they are not. They are neither inherently positive nor negative. They are neither good nor bad. They do not involve simple addition or subtraction. Accountants often show a T account to illustrate a transaction. Debits appear in the left side of the T, and credits appear on the right side. Different accounts have different types of normal balances. There are two types of balances, debit and credit. Asset accounts have debit balances. An increase to an asset would be a debit. When an asset is acquired, that would be a debit. A decrease to an asset would be a credit. Selling an asset, for example, would be a credit. The owner's equity account has a credit balance. A transaction involving owner's equity would be one where the owner puts money or something else valuable into a business, such as land. This would be a credit to the account. Making a withdrawal from the business would be a debit to the account. When entering a transaction, you must make an entry in at least two accounts. This is called double entry bookkeeping. The transaction may actually require an entry in more than two accounts. The total debits and total credits must be equal for the transaction. If you enter $500 on the debit side of an account, then you must enter $500 on the credit side of another account. Let's look at Johnny's transaction of putting $20 into his business. By doing so, he increased the cash by 20, which is an asset. When you increase an asset, the amount is placed in the debit side. We know that double entry bookkeeping requires an entry in a minimum of two accounts. Therefore, we need to make an entry in another account. Equity in a business is referred to as capital. I will use the account name owner's capital for the owner's equity. For a sole proprietor, I could have used the names net worth, capital, or paid-in capital. They are all equivalent names. By putting $20 in the business, he increased the owner's capital by 20, which is an owner's equity account. When you increase an owner's equity account, the amount is placed on the credit side. We keep track of all the transactions that occur in a business in a journal called the General Journal. Larger companies may have more than one type of journal. The General Journal consists of the page number, the date of the transaction, the account title, a posting reference, which I will discuss later, and the values for the debit and credit. The debit is always listed before the credit. The account title for the credit is always indented. You should always enter a description of the transaction. The description should be indented a space and should be in italics. The asset cash is debited for $20, and the owner's capital is credited for the same amount. Johnny doesn't have enough money to pay for the lemonade stand and the inventory needed to get him started. He borrows $100 from his parents. People you owe money to are called your creditors. Johnny's parents are now his creditors. If you owe money to someone else, you are a debtor. In a transaction where you are incurring a debt to someone, you would enter that debt on the credit side of a liability account. You are liable for your debt. This is why it is called a liability account. If you are paying off a portion or all the debt you owe someone, that would be entered on the debit side. Johnny borrowed $100 from his parents. The $100 he received is an increase to the asset account cash, so the $100 would be entered on the debit side of cash. The amount you borrowed from someone is entered into a liability account named accounts payable. The $100 that Johnny borrowed would be an increase to a liability, so it would be entered on the credit side. The General Journal entry for this would be to enter the date of the transaction, a debit of $100 to cash, and a credit of $100 to accounts payable. The debits equal the credits. Johnny now has enough cash to buy the lemonade stand from his friend. The lemonade stand is an asset. It is something of value to the business. You have learned that when there is an increase to an asset, it is debited. We debit lemonade stand for $40. In this transaction, we are exchanging one asset for another. We are exchanging cash for a lemonade stand. The asset cash has decreased by $40, so it will be entered on the credit side. There is no change in the value of our total assets. The transaction would be entered in the General Journal. A debit of $40 for the lemonade stand and a credit of $40 for cash. There are two more types of accounts we need to talk about. They are revenue and expenses. They are not listed in the accounting equation. They affect the owner's equity account. Expense accounts are equity accounts that have a debit balance. Expense accounts are called contra-equity accounts because their balance decreases the owner's equity balance. They are the costs incurred by a business in its effort to generate revenue. This includes costs such as salaries, rent, utilities, supplies, depreciation of assets, and interest payments. The accounting equation is assets equal liabilities plus owner's equity. But it may help to think of a revised accounting equation where assets equal liabilities plus owner's equity plus revenue minus expenses. Expense accounts have debit balances. An example of a debit to an expense account would be rent expense. Rent is a decrease to owner's equity. An example of a credit to an expense account would be if you received a refund on an expense, such as when a mistake was made on your rent bill. A credit to an expense account would be an increase to owner's equity. Examples of what you would enter in an expense account are salaries, rent, insurance, delivery charges, and depreciation. Revenue accounts have credit balances. An example of a credit to a revenue account would be a sale of a product. This would increase owner's equity. An example of a debit to a revenue account would be if you gave a partial or full refund on a sale. This would decrease owner's equity. The revenue account is also often referred to as sales, or, if it is a service business, it is often referred to as fees. Businesses may use other similar names to represent their main revenue account. If the main purpose of your business is to rent apartments, then your main revenue account may be rent revenue. Other revenue accounts may be interest revenue from a bank account, or a dividend revenue account, where you are getting dividends from stock that you own in another company. It's time for a self-check question. Which of the following will cause owner's equity to increase? Would it be expenses or revenue? Revenue is correct. Expenses decrease owner's equity. Let's review what type of accounts have debit balances and what types of accounts have credit balances. Assets and expense accounts have debit balances. Liability, owner's equity, and revenue have credit balances. Johnny wants to attract as many customers as possible. He pays $10 for flyers to advertise his lemonade sale. Because Johnny spent $10 in cash for advertising flyers, the asset account cash is decreased by $10. Decreases to an asset are credited. The advertising expense is increased, so it is debited. In this transaction, both an asset and owner's equity are decreased. In the general journal, Johnny enters the date of the transaction, debits advertising expense for $10, and credits cash for $10. Johnny decides he is going to make his lemonade from fresh squeezed lemons. He decides he will buy enough inventory to make 65 glasses of lemonade. The price for the inventory, including the 7% sales tax he had to pay when purchasing the inventory, comes to $63.13. If we divide the cost of the inventory by the number of glasses of lemonade Johnny can make, it comes to 97.123 cents a glass. We want to be as accurate as possible. Johnny plans on selling the lemonade for $2 a glass. Inventory is an asset. Purchasing an asset increases asset, so it is debited. Cash is also an asset. Cash is being decreased, so it is credited. This transaction is exchanging one asset for another. To record this transaction in the daily journal, Johnny enters a debit for inventory of $63.13 and credits cash for $63.13. People are loving Johnny's lemonade. Johnny sold 50 glasses at $2 per glass. Cost of goods sold, often abbreviated as COGS, is an accounting term that refers to the direct cost attributed to the production of goods or services sold by a business, including raw materials, labor, and other expenses incurred in producing the final product or service. There are two parts to this transaction. The first part is Johnny made $100 in cash from lemonade sales. This increased sales, which is a revenue, by 100. The second part is to record the cost of inventory sold and to reduce inventory for its costs. Remember, each glass of lemonade cost Johnny 97.123 cents a glass. Taking the 50 glasses sold times the 97.123 cents, it comes to 48.56. This means Johnny used $48.56 of his inventory. Since this is a decrease to an asset, inventory is credited for 48.56. The cost of the inventory sold in accounting is debited to cost of goods sold, which is an expense account. Looking at the transaction from another perspective, you can see that the asset account cash was increased by 100. Johnny's revenues increased by 100. An increase in revenue is an increase to owner's equity. The inventory that was used in the sale of the lemonade decreased the asset inventory. The cost of the goods Johnny sold is an expense which decreases owner's equity. To account for the sale of 50 glasses of lemonade, a journal entry is made debiting the asset cash for 100 and crediting sales revenue for the same amount. The expense cost of goods was debited for 48.56 and the asset inventory was credited for the same amount. Time for a self-check question. Cost of goods sold is what type of account? Is it an asset, a liability, an expense, or a revenue account? The answer is expense. Expenses decrease owner's equity. Johnny wants to sell more lemonade the next day. He only has enough inventory to make 15 glasses of lemonade. Johnny decides to purchase the same inventory items and amount that he did previously. Johnny needs to check his cash account to see if he has enough money to buy the additional inventory. If we look at the journal transactions involving cash, we can see that the total debits are $220 and the total credits are $113.13. This means that Johnny has a balance of $106.67 in cash. Therefore, Johnny does have a sufficient amount of cash to purchase the inventory. The transaction is added to the general journal. Johnny again pays $63.13 in cash for the same amount of inventory as he did previously. This time, Johnny sells 40 glasses of lemonade. The cost per glass of lemonade is still 97.123 cents a glass. The cost of goods sold is 40 times 97.123 cents, which equals 38.85. The accounting equation remains in balance. The transaction is added to the general journal. Johnny pays back his parents $75 of the $100 he owes them. This decreases the liability account, accounts payable. Remember, debits decrease liability accounts. The journal entry is made decreasing Johnny's debt to his parents by $75 and also decreasing cash by the same amount. You borrow $50 to be used in your business. Should you enter the $50 as a debit or a credit to accounts payable? The answer is credit. Your liability would increase. An increase to a liability is entered as a credit.